OD Jacob here. Today we're looking at the company Autoliv. It is in the automobile components industry, just over 10 billion market cap and just over 11 billion enterprise value, 18.7 current P. It looks like they develop, manufacture, and supply passive safety systems to the automotive industry. Growth has been very slow. You're probably looking at very low single digit revenue growth CAGR over the last 10 years, with gross margin and operating margin actually down a little bit, but fairly consistently about high teens for the gross margin, high to mid single digits for the operating margin. And pretty consistent earnings per share, dividends, slight increase as well. So you're not really looking at the highest growth sexy business, but these consistent businesses can absolutely have good value to them. And return on invested capital, high single digits. Balance sheet does show a little bit of debt here. We got 498 million cash on hand with 1.3 billion long-term debt, 538 million short-term debt. So short-term debt, not really an issue. Let's see what that long-term debt of 1.3 billion is in relation to cash flow. And I presume this other, I'm going to pretend that this other is part of this capital expenditures line. I presume it's just the way that this website takes it in from their 10K and 10Qs, but we're looking at about 400, 200, 200, 500. So probably about 300 million average free cash flow with 1.3 billion long-term debt. So a little over 4 years to pay it off based on their 5-year free cash flow. It's not a huge concern. I mean, it's less than 5, which, I mean, it can be less than 10, and it's really not a concern. Again, I'd like to think about these examples from the human perspective of if I just own a 30-year mortgage, it's all long-term debt. In relation to my earnings, it might be quite high, but it's paid out of the next 30 years. But if I have long-term debt due in 3 years and it's 5-year average of my free cash flow, then we're clearly going to get to a point at the end of 3 years that I have two decisions. I can either sell off assets, I can pay as much off as I can with the cash on it that I have, as well as the cash producing that I get, or I can refinance. And so you're not going to be able to refinance every single time, but I don't think this leverage ratio is so much that I'd be terribly concerned with that balance sheet. Their use of cash has consistently been, they made acquisitions quite a bit before COVID, but then since COVID's happened, they've been just paying a dividend, buying back shares, and debt is kind of going up and down. So I'll say that that's net neutral, but their dividend of 225 million pays out probably 60 to 65% of their 5-year free cash flow, and it is a 2% yield. So they are paying out a good amount of their free cash flow in a dividend, and then they're also using quite a bit to repurchase shares. But let's start making some assumptions here. Revenue growth side, I'm going to be looking pretty small here, maybe 3, maybe 14. I think that they'll still have growth ahead of them, but just not much. Let's do relatively in line with that average there. The share repurchases, 1% would be about 100 million. So all I did there was took the market cap. Current market cap was 1% of that to get to an estimate of how much they could buy back. With them paying out 224, I don't see them paying out more than like 100 million. So that would be about 1%. So this is assuming, let's keep the dividend the same. I know they've increased it historically, but I want to keep it the same because at the end of 7 years, if they increase the revenue, increase their earnings and free cash flow, then that 60 to 65% payout ratio goes down to more like 55, 50%. And so here is saying that they use 50 to 60% of their free cash flow on a dividend, about 30 to 35% on share repurchases, and then the rest are going towards making efficient acquisitions, reinvesting back in themselves, and it does still look quite a bit overpriced given these assumptions. And with that, I hope you have a great rest of your day. Thank you.